how do these massive recessions, like nasty recessions, I mean nasty ones like a 2008, typically it's because of something in the financial sector. And
Correct.
that's typically what causes it. And if we've, learned our lesson, and there's going to be new lessons to learn along the way, don't get me wrong, but we know now that we have to support banks. And that's the most crucial thing to the liquidation, lubrication of an overall economy is the access to money. And if people can't access money, it becomes a problem.
Folks, you asked for this. More than a dozen of you sent me a video talking about the M2 money supply falling 3.94%, echoing a call for Great Depression 2.0. Apparently, the M2 money supply has not gone down greater than 2% ever without it signaling a Great Depression. So it's now down 3.94%. Is a Great Depression around the corner? We're going to talk to a 10-year Wall Street veteran, Taylor from Life Goal Investments. How you doing, buddy? Great Depression 2.0.
Good. Here it comes. Watch out. Get your bunkers ready. Yeah, it is interesting. If there is, if you went throughout history and you followed the supply of money, just how much money is being injected into the economy and turning over in the economy, it is one of the greatest forecasters as to where the market goes, where the economy goes, et cetera. If it was one thing and you were looking at it in a silo, not the worst thing to choose, honestly.
Yeah, it's not bad.
I don't agree with this call. And the reason I don't agree with it is we just had the most massive glut of stimulation we have ever seen by epic proportions that came through COVID. And so one of the things you can see is that the trend line, call it a 30-degree angle or whatever. I'm not good with angles, 12-degree angle. We're still well above the trend line of pre-COVID. So this kind of hiccup back downwards, although it might be the most meaningful ever, also the stimulus we just pumped into the economy is the most meaningful ever. So it's all about, okay. And I usually am a rate of change person. Rate of change is incredibly important. And that's what this is measuring. It's coming down, but it was so high and so inflated because of COVID that this is not a huge concern to me.
Yeah, I think there's a couple of things. The first thing, especially with this metric, is we do got to zoom out.
Right.
So again, I'll just round it up. We're down 4% from the peak. I will agree that that statistic is absolutely accurate. But if you zoom out just a couple of years, you will realize that the M2 money supply is up 29%.
Wait, what was that?
29% in just a couple of years. That is absurd amount of money supply.
And by the way, yes, we are squeezing on one side, on the monetary side. We're still loose as a goose on the fiscal side, right? And so that in combination, that is also measurable. So you can look at, so there is an awesome statistic out there that's run by the Chicago Fed called the National Financial Conditions Index, NFIC. And the NFIC measures 105 underlying statistics about financial conditions. You want to know how many of them are tighter than average right now?
0.
4.
Wow.
There's 101 of the financial conditions that they measure out of 105 that are looser than average right now.
Right.
Looser, and so, So sorry if I tried to elude you there. Yes, it is incredibly loose right now. And you think about it, the only thing that's being hurt right now is essentially the fact that the federal funds rate is high. And that does drive variable rate, adjustable rate debt.
Correct.
But as you know, in the real estate business, big corporations, homeowners, et cetera, are not exposed to this movement in interest rates. And, 10, 15, 20 years ago, a significantly higher percentage, and you might know the number better than me, but 15% of mortgages or something like that were adjustable rate in their nature. And that would tremendously hurt what's going on from an overall consumer perspective. And if you look at a country like Canada, it is, because they have 3- and 5-year mortgages that get adjusted there. But here in the States, everyone's locked in for 15 or 30 years. And thus, it does not impact the biggest expense. And thus, that's also why higher interest rates have not slowed down our economy to the pace that they have in the past.
Yeah, I think one of the things that's important for you and I as guys in the weeds to kind of educate the audience on is what is in the M2 money supply and what is not.
Yep.
And the reason this is important, if you're going to acknowledge that the M2 money supply being down 4%, and you and I are both saying it's not an issue, I think we owe them why it's not an issue. And
Yep.
other than, 29%, 4% reversion to the mean, that's all cool. But hey, it is down 4%. Why? So I poked at this a little bit, and let's do this first. I'm going to list some things, and you're going to say whether or not it's in the M2 money supply. Sound cool?
Ooh, little quiz, little quiz. I like this. Let's do it.
Cash,
Yes.
savings and checking accounts,
Yes.
money market accounts.
Yes. Different than M1, M2 it is.
It is an M2. Yep. Stocks.
No.
Bingo. That is the thing that I don't think a lot of people realize. So let's talk about that right there, because I think that's what people are missing. About 6 or 9 months ago, because M2 money supply is measured on a quarterly basis, what was going on? You and I were talking about consumers putting money in money market accounts and earning 5%. Remember,
Mhm.
we were all
Mhm.
scared that a recession was coming,
Mhm.
right? So that was 9 months ago. 6 months ago, you and I were having conversations about trillions or billions or whatever it was of money, dry powder. Remember that? We have dry powder on the sidelines.
Yep.
So what has happened over the last quarter? Well, we've got the stock market at all-time highs, right? So what's happening is we are seeing money race off the sidelines and be put to work. So all we're seeing, folks, is people be less scared, take money out of money markets, out of savings, and put it into the stock market. That is what has happened because the
Roaring Kitty's
consumer.
got GameStop up 100% again today.
Did you see his portfolio? He's got like 120,000 call options in June 21st or something crazy.
Unbelievable. Oh, something like 100 million notional value in GameStop. Like, what is going on? But that's the point, is like there are some animal spirits that are out and
Exactly.
about now. And animal spirits in the stock market, to your point, don't get accounted for in M2.
And I think I saw Bitcoin today was back over 70,000. Let me check that.
Bitcoin's pumping too.
Oh, almost. So it's just under 70,000 right now. But yeah, again, it's there's money out there, folks. There's money on the sidelines. And guess what? It's coming out of M2 into M3. So yes, M2 is down 4%, but from where I sit, it's like no kidding, it's down. It's
There's a
dry
lot of
powder going to work.
there's a lot of different data points that you can look at. So one of the biggest things that you can look at is credit spreads. So credit spreads are, if I'm a company and I'm going to go out and issue debt, the spread is, okay, here's what the comparable treasury is at. So if I'm issuing debt for 10 years, treasury's at 4.4, 4.5, wherever it is. Then the spread is how much I am forced to pay on top of that, because that's your risk-free rate. So if I'm a high quality company, investment grade corporations, they're going to pay 100 basis points, 1% over. And so that is incredibly tight relative to long-term average, meaning that people are willing to go out there and take on risk buying companies their debt, that they have the ability to fulfill their debt obligations. You can tell that because they're not being forced to pay a big amount, a big premium over the risk-free rate. And that's the market saying all systems go. We are not in recessionary territory whatsoever.
Yeah, it's pretty wild to think about. So again, I think there is a story, a very logical story about why M2 money supply is down 4%. I do think it's accurate to point it out. I think it's accurate to point out that, the last 4 or 5 times that happened, a depression occurred. This hasn't occurred since the 1930s. So again, it is a little bit unusual.
By the way, half of these recessions or depressions that we're talking about were pre-Federal Reserve,
Yeah,
right?
they're in the
So
1800s.
let's also talk about the fact that, like, listen, we just saw what happens when a bank goes under. The Federal Reserve steps in and says, anyone that's a bank that needs money that can't fulfill their debt obligations or their withdrawal obligations will
We
step
got
in.
you. Yeah,
Guess
we
what?
got you.
That wasn't around when these depressions took place. Like, we learned our lesson. We took our pill from 2008. If 2008, like, this is something that people don't understand. In 2008, I'm not saying a nasty recession wouldn't have presented itself, but if the regulators allowed Bear Stearns and Lehman Brothers to come together, that would have looked incredibly,
Very
incredibly
different.
different. You would not
Very.
have had the systemic kind of problems where we thought we didn't know the security of our banking system at large. And a lot of that could have been alleviated by them allowing them to come together. Now you look at it and you look at the difference in how we react. JP Morgan is above the 10% of all deposit limitations that we can take in this country. If a bank goes under right now, guess who's buying it? Jamie Dimon, JP Morgan, because the regulators are like, instead of facing a situation that played out in 2008 where banks start going under and people start to question the wherewithal of banks, we'll let a big one take it out. Whatever. They're good. Money good. Let it roll.
Yeah, it's funny. It's the same thing in the real estate game. I think the regulators and operators realize that foreclosing out a bunch of properties at the same time is not great for your balance sheet. So
No.
let's just do forbearance at a drop of a hat and extend and pretend and add-ons and just it's just a totally different game. 08's not going to be repeated. Not to say that a crash couldn't happen, but it will be a different kind of crash, not like 08.
And one of the things, kind of from a long term perspective, of like, hey, how do these massive recessions, like nasty recessions, I mean nasty ones, like a 2008, typically it's because of something in the financial sector, and
Right.
that's typically what causes it. And if we've learned our lesson, and there's going to be new lessons to learn along the way, don't get me wrong, but we know now that we have to support banks, and that's the most crucial thing to the liquidation, lubrication of an overall economy, is the access to money. And if people can't access money, it becomes a problem.
There you go. Taylor, you put out a lot of great 60-second education videos. Where can people find those?
Yeah, thanks so much. You can find us on Instagram and on TikTok. We're at Life Goal Investments.
Thank you, buddy.